All right, guys, stay tuned, and we're going to talk about PMI. What is it, and how much is it going to cost you?
You better get fired up.
Guys, happy Monday. Good to see you on What's Hot. We're here every single Monday at 11 o'clock where we talk about the hottest things in the real estate market. And right now, one of the biggest questions I've been getting is, what is PMI, right? PMI stands for private mortgage insurance. And anytime you have a private loan, which is a conventional loan, there's going to be an attached PMI payment in a lot of cases. If you get 20% down, that payment goes away. But if you don't, the attached payment is there. Let's talk about why first. Why is that added payment there? Well, first of all, you've got principal, interest, taxes, insurance, and a potential HOA fee if you're in an HOA. And then that sixth thing is that PMI or private mortgage insurance. It is there as insurance for the company giving you the loan so that they are able to insure against default. So they look at all the different factors. We're going to talk about the factors here in a second that are involved with calculating the private mortgage insurance. And based on how well you score, they're going to give you different rates of mortgage insurance. And it's just like any other insurance, right? They're looking at what are the odds you default and how much are they going to have to charge you to cover the typical loss that they're going to take with you. So they're not going to lose on every single person, right? It's single digits people who end up defaulting on their loan. So 90+% of people they're going to make their payments. So they're looking at the default rate. How much is it going to cost? What do I got to charge people to actually make a profit on this and not lose our butts on this? And that is what they charge. The reason they don't charge people with 20% down is because the risk level is so low on somebody who's got that much skin in the game. They're probably not going to default on their home. They could pull out a home equity line of credit. They could sell their home. There's a lot of different things they could do, but going in default is probably not what somebody with 20% down is going to do. Does it ever happen? Sure, but it doesn't happen a lot, and that's why they don't charge them PMI. Now, if you look at a federally funded loan, a government loan, which is FHA or VA, those loans are going to have something very similar, but it's called MIP instead of PMI. So PMI is private mortgage insurance. MIP is mortgage insurance premium. All right. But it's very, very similar. And there's equations that go along or calculations that go along with being able to determine how much you're going to pay. And I'll tell you right now, I don't suggest you try to do the math yourself. I think your lender should walk you through that because there's ever-changing things that will impact that, your credit being one of those things. But I am going to share right now my screen, and you should be able to see this is off of nerdwallet.com. Okay, and it's showing you not specific numbers, but averages, average annual PMI amounts on your loan, depending upon your credit. And I want to tell you, credit's just one thing that they're looking at in determining this, right? They're also looking at your loan amount. They're looking at how much you're putting in down payment. So the more you have in down payment, probably the better PMI rate you're going to get. They're looking at your debt to income ratio. The more debt to income you've got, the scarier you are, the riskier you are, then your payment's probably going to be higher. The lower it is, obviously, the lower it's going to be. And obviously, you can see here on this chart that the better your credit is, the lower your PMI is going to be. So let's look at that 680 to 699 at 0.98% because, well, let's just pull out a calculator here. So on a $400,000 home, let's say you're putting 5% down, $400,000 times 0.95. That means you've got a $380,000 remaining mortgage. Okay. So at 680 to 699, the average, and again, there's a lot of things that calculate into this, so this won't be exact for you, is going to be 0.98% a year. So times 0.0098 divided by 12, that's an extra monthly payment of $310.33. Now, let's say you've got tougher credit. Let's go down to that 620 to 639, and we'll come back to that same $380,000 mortgage on a $400,000 home with $20,000 down, which is 5%. And you're looking at 1.5%. That's going to be $5,700 on the year, or an extra $475 a month. Okay, so it is important to get your credit up. If you're going to have PMI or MIP, it's important to get that credit up before you actually lock into a loan, because this is going to stay with you for quite some time, right? Now let's go down to that beautiful area. That's 760 and above. Again, the same mortgage, $380,000, 5% down on a $400,000 loan at, oops, I added too many zeros there. 0.46% is the annual average. You're looking at $1,748 a year, or just over $145 a month. So that's $145 versus $475. That is a drastic difference. What is that? $330 a month. 330 times 12. That's almost $4,000 a year you're saving just by having strong credit, right? So some really cool things to kind of look at, but I want to make sure that all of you guys are aware that that is an added payment that you're going to want to calculate in if you do not have at least 20% down. And if you want to know if the numbers truly matter to you, make sure that you reach out to your lender and say, hey, can you run my numbers? Can you look at my credit? Tell me, based on a home at roughly this price with roughly this much down, what would my PMI be? What would my MIP be? And they will tell you that number. Now you can start to look at, okay, what will my principal and interest be? That's your mortgage payment. What are my taxes going to be? Right. And if you guys have questions on that, just YouTube, Joe Rosen, taxes. And I've got multiple videos going over that, right? Because there's a lot of intricacies with that. Look at your insurance. That's super easy. You can call an insurance guy, and within 2 minutes, he can give you a rough estimate of where you're going to be within a couple $100 on your insurance. All right. Then add in that MIP or that PMI from that lender. They should be able to share that with you. Don't forget about HOA payments if you're in an HOA, and boom, you add all that up and you've got a very accurate depiction of what your monthly payment's going to be. Guys, I hope this was helpful. If you've got any questions or comments, please put them down below. And if you've got something you want me to touch on in the market that's hot, let us know for what's hot next week at 11 o'clock. We're here every single Monday. Guys, thanks for joining and have an absolutely wonderful Monday. Take care.